Hello, everyone, and welcome to Meeting of Manager Minds. In this podcast series, we'll be unpacking some key insights from versed asset managers, skilled investment professionals, which we use in our portfolio solutions. In essence, AF portfolio, AF Performer, which we use in one of our, Truffle Asset Management we utilize in our portfolio. My name is Msizi Msomi. I'm the portfolio manager at Alexforbes. With me today, I'm joined by Saul Miller, portfolio manager at Truffle Asset Management. He will be unpacking some of his key insights and just giving us some expert knowledge from his experience, from his years of experience. And obviously, with Alexforbes being the investment destination choice, we're proud to be the largest multi-manager in South Africa with over 560 billion of assets under management. In our process, where we select managers, the best of breed asset managers, where we select them from a universe of asset managers and blend them together to create a single portfolio, which we then take to market to clients and we employ, and this is all built on the foundation of our multi-manager approach. As Forbes being the investment destination of choice, we are proud to boast being the largest multi-manager in South Africa with over 560 billion of assets under management. And I guess, this kind of gives advisors, investors, a peace of mind to know that we're managing the complexities of constructing portfolios, and we employ skilled asset managers like the likes of your Truffle Asset Management to manage these stock picking processes, build and construct portfolios, essentially doing the heavy lifting from a stock picking perspective. In this episode and episodes to come, we'll showcase how we select managers, the process thereof, and we'll just highlight and give key insights and expertise from experts in the industry. With over close to 3 decades of performance track record, Alexforbes Investments prides itself in constructing portfolios with the basic foundation of that whole multi-manager approach. And whether you're an advisor, an investor, or just a curious observer, just seeking to get knowledge and expertise and insights, you're in the right place. And if by a way of introduction, Saul Miller, welcome. And maybe just briefly tell us about yourself, the firm, who Truffle is, and maybe just unpack that for us.
Sure. Truffle Asset Management has been around for about 18 years. We currently have 100 billion of assets under management, and we manage various different mandates from fixed income to equity to multi-asset, in other words, combinations of those two, so the likes of low equity or balance funds, which are suitable for Reg 28 or pension fund type vehicles. There's a lot of depth of experience, so a lot of the portfolio managers, they all have well in excess of 20 years of experience. We've worked together as a team also for many years. That's sort of the short story about Truffle.
And who's Saul?
I am one of the portfolio managers at Truffle. I've been at Truffle since 2016, and I oversee quite a few of those mandates that I spoke about. So I'm involved in co-managing the equity funds as well as multi-asset funds like balance funds and low equity funds.
And balance funds, that's a combination of various strategies, various asset classes, maybe just...
Sure, that would be a combination of equity or stock market shares, as well as government bonds and cash and credit type instruments.
So in your portfolio construction, you pick stocks to kind of combine that into a blend which ultimately feeds into a portfolio.
That's correct. You want to have a diversified spread of shares and bonds, and you obviously want to also spread it amongst the different asset classes. So the aim of it is to obviously give the investor a diversified exposure so that they're not at risk of underperformance of any particular counter or any particular asset class.
Awesome. So I guess maybe I think this is one of my favorite segments of the podcast, is to just have a little icebreaker. I know we've already met and all of that, but I guess maybe if you can just give me 2 truths and 1 untruth, and let me try and guess which one is which about yourself.
I'll give you one that's actually a bit of a truth and a lie, I guess.
Okay.
So a comment you often hear in investments is, this time it's different. Mm-hmm. And usually what happens is, if you're a very young investor, we all obviously start somewhere, and when we don't have a lot of experience, we generally caught up in what's happening in the environment of the time. So we might invest in a certain share where the environment is very positive, the company's doing particularly well, and we want to value that share on a very high valuation because everything looks rosy, everything looks good. You'd have this young investor usually speaking to their boss, who might be a portfolio manager, and the portfolio manager will say, but this is very expensive, and the young analyst would say, yeah, but this time it's different. I mean, things are really going well now, because they haven't looked at the fullness of history. And the wise portfolio manager that's been around will say, no, you are wrong. This time is not different. If you look at the history, this company has done well, it's done badly. This is just a cycle, and you're just at the top of the cycle at the moment.
Yeah.
And so he'll tell the young investor, you are wrong to assume that this time is different. Mm-hmm. But actually, in truth, what you find is that things are going to happen in your investment career that have never happened, not just previously in your career, but have never happened in history. That is what makes markets quite challenging. Sometimes things really are different, and that can actually be quite a truism. And I mean, one of the hard lessons I had to learn was there's this very well-known indicator of value called the Schiller PE, and it's introduced by, I don't know if you know it, he was a Nobel Prize winner in finance, Robert Schiller. He was at Yale University, or probably is still at Yale University. And this valuation metric it's a price earnings ratio, but it's based on mid-cycle earnings. And he did his work mostly on the S&P 500. And for 100 years, this valuation metric would mean revert quite nicely. Even statistically, you could show it. Did it with a high degree of statistical significance. Secondly, it was quite a good predictor of future returns. In other words, when it was high and it shows markets were expensive, on a 10-year view, generally they would underperform. And it worked well for over 100 years. It just stopped working quite close to the beginning of my professional life. And it probably kept me out of the U.S. market for longer than would have been, than was justified. So there are other examples of those, but it's important to remember that things, certainly can be different this time. And probably another truism from that is that there aren't really a lot of hard and fast rules that always work in financial markets. That's why 100%. It's tough to outperform in financial markets.
Okay. No, that's actually quite an interesting perspective there, Saul. And I guess maybe just then to touch on your business or the firm, Truffle. What gives you that competitive edge? From your philosophy, the way in which you manage and pick stocks. Maybe just highlight some of those nuances in terms of you getting that competitive edge.
It's probably a combination of factors, and maybe it'll help if I just touch on what our investment process is to highlight why I think it's relatively unique. Not everything we do is obviously unique, but I think when you put it all together, it is reasonably unique. I mean, we generally believe markets are efficient over the long term. So over the long term, shares will be priced efficiently, but over the short term, they will be inefficiently priced. Short-term news flow will obviously push share prices well above what could be considered an intrinsic or fundamental value of a business, and that's what presents us an opportunity to buy or to sell when it's expensive, or buy when it's cheap. So we do a lot of work into working out an intrinsic value for a company, which should be a stable which should be a stable value over time. That requires a lot of work on whatever company and industry that company is in. It's based on history, but not only on history. We also have to allow for the fact where history or where the future will be different to history. So that's very important. We're not just taking averages of history and getting to our valuations. I think that's very key. We get to a value, and that sort of obviously gives us a sense of how much upside or downside there is in a share price. And that's really half of it. That's your expected return that you're going to get. But the other part of it is how much confidence do you have in that value? And that is going to vary from industry to industry, share to share. And that really is as important as working out a value. Because what we're trying to do is we're not just trying to pick winning shares, we're trying to avoid losing shares. So we'll often find shares that might have 50 or 100%, but there's a huge amount of risk associated with that. There are a whole lot of things that have to fall into place for that return to be borne out. And we give a lot of consideration and spend a lot of time thinking about that. And if we don't have a high conviction in that estimate that we have, we will not invest in the share. So when we're deciding on our position or our size of position in a company, it's got to be a combination of those two things. Your upside, your expected return, and how much conviction you have and the risks associated with it. So those are two key factors. You need, I'd say, quite a bit of experience to do that. That's not something you learn immediately. And a lot of it boils down to using a lot of common sense, which should be easy, but it isn't. It takes time. And we think, we are good at doing that. And part of that does come from the fact that we are a very experienced team. I mean, as I said earlier, the PMs portfolio managers have had many years of experience. We've lived through many different business cycles and economic cycles. And we think that helps us in identifying those risks and deriving values for companies.
And I guess that experience, comes in quite handy when you've been managing money through various market cycles, various economic cycles. I'm sure you've lived through, the 9/11, the GFC, all these, and maybe is the saying true that this time's going to be different?
Some things are going to be the same, and some things are different. Living through those cycles it's definitely helpful. But the one comment is history doesn't repeat, but it rhymes. There's an element of truth in that. But some things are different. I'd say the performance of the Magnificent Seven shares, the tech shares in the States, their period of performance has been it's been incredibly long, and some of it has certainly, or a lot of it has been justified. They have managed to generate fantastic outperformance and profits for a very long time. So it's quite justified. So we've almost seen, as a result of that success, levels of concentration in the S&P that we actually haven't seen in history. And some of it is justifiable. Is it sustainable? That's the question. We think there's a lot of risk around that. So, we find that there are places where there is less risk to invest in, where there's, where we think you can also get good profit. So, we are not particularly exposed to the States because we think there are risks associated with that.
I want you to hold on to that thought around the Magnificent Seven, because I have another question later on where, I'll ask you to talk about the Magnificent Seven and that whole AI theme. But
sure.
That's coming up. I guess one would then, want to know, yes, you have an intrinsic value, you determine the value of a stock, you determine the entry price of a stock, and you determine the exit price of a stock, and this is all based on your philosophy and how you manage funds. Now, in terms of how you actually construct that portfolio, maybe just unpack a bit from the time you generate an idea
Sure.
maybe for a particular stock, and these stocks are companies, companies that people operate on a day-to-day basis. Maybe how do you then construct your portfolio from the time you generate the idea to the time it's expressed in a portfolio within that you manage?
Right. So as I said, we determine valuations for companies. We determine intrinsic value. You can compare that to the share price. That gives you an expected return. That all feeds into what we call a ranking table. So we can see the expected returns of all the companies, which are expensive, which are cheap. And that's really half of it. The other half is obviously we then have to give a lot of thought to the conviction levels of those intrinsic values and expected returns. Do we have high or low conviction? You put those together, that gives you a sense of how much you would want in a particular company. Do you want, a lot or a little or none if it's too risky or too expensive? That's sort of the bottom up, what you'd call the bottom up portion, where you're picking all these shares. There's then what you would sort of call the top down part of the portfolio construction, and there what you're doing is you want to make sure you're not overly exposed to one particular share or one sector of shares. That's really because you want more of a diversified return. You want to get your return from as many sources, many independent sources as possible. And obviously, shares within a particular sector tend to be correlated. They tend to move together. And that's why you look at concentration, not just by shares, but by individual sectors. And you try and make sure that is reasonably spread out. Another factor that you will look at is the sensitivity of your shares to various political and macroeconomic factors, because they will be impacted differently by different shares will be impacted differently by those factors. So what's happening in China? Is China becoming a more favorable destination? Are they cracking down more on industry? Are they being more friendly? Has a huge impact for a company like Naspers, which invests in Tencent, which is obviously listed in China. So, recently, the fact that the government or Xi embraced a lot of these tech leaders, which, they were sort of persona non grata, a lot of them were at least, and now he's kind of brought them into the fold again. That's obviously important if you want to develop technology and you want your economy to grow and outperform your competing countries. And that change was very important for us. So that led us to be a lot more comfortable with a share like Naspers and Tencent. So we want to reflect that in our portfolio, and that improvement or that improved outlook for China on that factor, which we think is very important, because how you perceive business is obviously quite key to how shares will perform and how they will be valued by outsiders. So that change led us to have a larger position in a share like Naspers. And there are many factors. There's Trump's policies, in terms of tariffs, and if you can make sense of them, it would help even more. It's obviously quite difficult to decipher what is just sort of verbiage and what is he actually going to follow through with. But you certainly want to consider that in your investment and in your portfolio construction, because there's certain things that can be negative and there's certain things that can be positive for certain companies. If you look at Europe, you've got a huge stimulus package that's been passed in Germany that is very positive for Europe. A lot of bases are very low in Europe. Consumption's low, manufacturing's low. You put that together with the stimulus, it presents a lot of opportunity. It means more favorable valuations for these companies, higher earnings for a lot of European companies. So once again, you want to relook at your bottom-up valuations for European companies and assess whether that is tying up with this macro tailwind that they are getting, and you would adjust your portfolio accordingly.
So I mean, just to kind of expand on it a bit. So you have that bottom-up.
Yes.
Bottom-up, maybe, just to explain it, is essentially picking or maybe evaluating stocks from that fundamental level, looking at financials, and then you have the top-down approach where you look at the macros and do the valuations and the macro overlay make sense? Do they talk to each other?
That's right.
And it somehow intersects.
That's correct.
That's where you then make a decision as to buying a particular stock, being
Correct.
Overweight or being underweight. Is that
that's right? Because
assessment?
your environment can affect the valuation of companies.
So I mean, so we've spoken about portfolio construction. I guess now the point I think you've also alluded to is that whole AI theme. You mentioned Magnificent Seven. What are your views on AI? Where do you see it going forward? Should we be worried? Should we embrace it? Are we too late? Are we too early? Maybe just unpack that for us.
I think it's got significant ramifications for consumers, for businesses that use AI. It's probably got ramifications for employment that we are yet to see. Whether that's a net negative or positive, it may well be a net negative, but I think we have to wait and see. Where it isn't clear is the monetization of AI by the providers of the AI technology. So you've got the AI engines, whether it's DeepSeek or ChatGPT. There's a lot more uncertainty as to how they will monetize that opportunity. So companies that make use of that will certainly get a benefit. You'll get a productivity benefit. But whether the makers of those engines actually make money is debatable. And part of that boils down to how do they differentiate between themselves? Are these engines going to be differentiatable, or are they all just going to be fantastic and get better at the same time? So there's a big question mark over who actually makes money from it. There's obviously question marks around the CapEx providers, the semiconductor manufacturers. As we saw with DeepSeek, suddenly you could bring the cost down in terms of the hardware that you need. So there's a big question mark on that side as well. So there's certainly a lot of risk around the AI hype for some of those companies, and that's something we worry about when we look at the valuation of some of them. They're not all expensive, but there certainly are certain areas where they are, and there's a lot of uncertainty as to what the sustainable level of profits will be, which is why we've generally steered relatively clear of them.
And in terms of, when you look at that whole AI theme, tech theme, what's going on with Trump 2.0, the tariffs, energy, China, all of that, where do you see the pockets of opportunity, and where do you see the risks in all of this? Maybe just highlight a bit on that.
Okay. Well, the opportunity is that Europe is having to pull together, and let's see how much they do pull together. But we've already seen the stimulus bill being passed in Germany, and it's not just for defense, it's also for infrastructure. So this is very positive for Europe, and you can see it in certain sectors. You're seeing it in defense, which in defense counters in Europe have done fantastically well. We still think there's an opportunity there. Financials in Europe are also a place that are offering quite a lot of value. There should be more work for financials as well, and they are offering really healthy returns if we look at the kind of dividends and share buybacks that they're doing. So that's also another great opportunity within Europe. So there definitely are some opportunities, despite the uncertainty that we're seeing and the level of conflict that's obviously risen in the world. It's not all bad. But there certainly are risks for the US now. We're seeing a lot of economic data coming out of the US that is net negative. Consumers are certainly getting a bit more worried. It's tougher for businesses to come up with CapEx plans and for budgets because they don't know what's happening in terms of tariffs. So it's certainly a net negative for the US. The question is whether he pulls back or not. But if he doesn't, we could certainly see more pain in the US market. It's fairly uncertain. We're staying away from that. We've preferred to go into Europe. We've even got a little bit of Chinese exposure. Okay. China's not without risks. We've seen a lot of stop-starts with China, but we do think things are moderately better, especially, as I said, with this embracing of certain tech CEOs. I think that's positive. Once again, the government is trying really hard to improve consumer confidence in China. That's really been a huge problem with China, is that consumers save a ton. They don't spend. It's a very unbalanced economy. They are trying to change that. Whether they can remains to be seen, but I still think China's in a better place today than where it was sort of 2 months ago. So we do have a bit of exposure there as well.
Okay. And that's on the global front. Now, just bringing it maybe a bit closer to home, which areas are you seeing opportunities and risks in South Africa?
I think things probably got a little bit ahead of themselves towards the end of last year. So we were very positive post the election. And we had sizable exposure to SA exposed companies. So as you know, on the JSE, some companies are very exposed to South Africa if it's retailers or banks, but some are dual listed or completely exposed to offshore and have nothing to do with South Africa, like a Richmond or a Bidcorp or a British American Tobacco and so on. Or you've got your commodity companies that are a whole different kettle of fish. So yeah, we have reduced our SA exposure a bit. I think the budget was not hugely positive. It wasn't bad. But one thing we're not seeing is a curtailing of expenditure from government. And I think we need to see that so we can get onto a better debt to GDP trajectory. And that's sort of staying kind of where it is, which I think is probably a bit of a net negative. So yeah, we're not as enthusiastic as we were a couple of months ago, but there is quite a lot of value in the SA market. I mean, we think there's a lot of value in financials, in some of the insurers, and particularly the banks. They have fantastic dividend yields. They are going to grow those dividends, even if things are a little bit tough. We're probably going to see some growth. So you're probably getting very high teens returns out of your financials, and that's a good, a high teens return with inflation sitting at 5% odd. It's a little bit lower than that now, but if we assume that's a long-term number, that's a very good return. So there certainly are opportunities like that in terms of domestic exposure. We have some businesses, as I mentioned earlier, that are listed here but are really exposed to offshore markets, which are also offering fairly decent value. And an example of that would be Anheuser-Busch is not trading on a particularly aggressive valuation. That's a business that will actually do well when the dollar starts to weaken, because they have a lot of exposure to emerging markets, particularly in South America. They borrow in dollars, so a weaker dollar is obviously positive. Bidcorp is a food service business based in Australia and Europe primarily, which is a very high quality business. And that's trading on a very reasonable multiple, not too dissimilar to some of our SA valuations. So you've got those opportunities as well. Hopefully, if we do continue to see a bit of dollar weakness, we might get a little bit of an improvement in commodity prices, and that should be good for some of our miners, like Anglo-American. I mean, they've got some specific factors that could be positive for them. They're obviously, they're obviously spinning out certain businesses. And they're going to become predominantly a copper-based miner, and have very high-quality copper mines. And copper mines generally trade on high valuations because copper is very sought after. The world is expecting deficits in copper over the next 10 years. So if that is your primary commodity that you are mining, you should attract a generous valuation. So that's another example of a share that we think that should do well. So the different sectors in the SA market that should offer some decent upside.
Sounds like you've got a well-diversified portfolio there.
That's certainly the aim. You want to have as many different sources of return. So if something doesn't work out, it doesn't overly affect the entire return of the portfolio.
And I guess, having that well-diversified portfolio comes with experience, being through various market cycles. And one would imagine buying and trading stocks would come with certain lessons. I'd say war stories, as it were, where you've probably got your fingers burnt, or you've got a few accolades. Maybe just share some of those war stories from that whole investment perspective. Some lessons that you learned. Sure. That would be quite insightful as well.
So earlier on, in my career, I used to have a predisposition to very cheap shares. In other words, shares that would trade on very low price earnings multiples, or would trade on huge discounts to their book value. What you realized was that if these companies weren't generating a lot of cash or weren't growing their earnings over time, they could just remain cheap for very long periods of time. So that was one of the early lessons that I learned. Another lesson I suppose I would have learned was that great companies need to trade on fairly expensive multiples. If they're good businesses, they have pricing power, and they're going to grow for many years, you're probably going to have to pay a higher valuation than they even might have traded at historically. So you look at their history and you think, it's trading a little bit above where it used to trade. If they're going to grow for a long time and you have conviction in that, you have to accept that you're going to have to pay pay up for them. So that's, the other side of buying cheap, is also realizing you sometimes have to buy things that might appear on the face of it expensive, but probably aren't when you take a long-term view.
No, sounds very interesting, and I'm sure through that whole learning process, it wasn't happy times.
No, there's a lot of you go through a tremendous amount of pain in your investment career.
So I guess now it just brings me to another segment where I'm just going to ask you rapid fire questions.
Okay.
So
not too rapid fire.
Hopefully not too rapid for you. Short, sharp, snappy kind of responses. Don't have to go too much into detail.
Okay.
First one. Best and worst investment ever?
Best investment was sort of early 2000s. There was a small cap boom. A lot of great businesses, small caps, got sold down to nothing, and they're too many to mention. But you had great businesses on 2-3 PEs. There were radio stations. There were building companies like Iliad. There's an engineering company called Howden. So those were probably the best. Yeah, that was unfortunately a long time ago. Those were my best. And then my worst was being underweight the US has really hurt.
Okay. So before you go to a meeting, or you get off a plane, you wake up in the morning, what's that one indicator, that go-to indicator, market indicator, that once you've seen it, you kind of have a broad picture of what's going on? What's your go-to indicator?
Well, is that a go-to indicator? You mean that I'd get excited about the market? Or is it just, you obviously look at market indices and you look at the key things that are moving markets. So it's whether it's US bond yields, it's the US markets. The thing I'm often looking for if I want to get excited about a market or a share is really, am I seeing increased or a reason for increases in earnings expectations? Okay. I'm sort of looking for things around that. That's usually going to drive share price momentum in the short term, at least.
So when you wake up in the morning, do you look at the rand to the dollar?
I have over 100 things that I look at in the morning. Okay. When I get to the office. I've got a terminal with many screens. There's a whole. There's a lot of commodities you have to look at. There isn't just and I'd like to say there's one thing, but there's there. You generally want to look at what the U.S. market. You want to look at U.S. bonds. You want to look at some of the futures markets. But there are a lot of commodities you want to look at that really matter. So there are a lot of things that I look at. Yeah.
So maybe this is an interesting one. If you weren't in finance, what would Saul Miller be doing right now?
What would I want to be doing, and what could I be doing? I probably would have liked to have worked in medicine or in engineering. There are a lot of interesting fields out there. Yeah.
Okay. Oh, I can see that. And so, one book or podcast, doesn't have to be this podcast.
Okay.
That you could
outside of this podcast that I would listen to.
That you could possibly recommend.
There's a podcast called Business Breakdowns, which is great if people want to learn about different businesses. It's mostly international businesses. For politics, I sometimes listen to. The rest is politics, which gives sort of cover the world's politics. Books. I haven't read anything for a while. I really enjoyed The Lords of Finance, which is a kind of overview of bankers and central bankers over the last century. And key decisions that they had to make and navigating finance policy over world wars. It's kind of a history of central banking that I thought was very informative.
Interesting. And in the case of a bull or bear market, whether there's a market is an upward trajectory or on a sell-off, where do you think you learn the most?
Both.
Maybe just...
They both. All markets, you're going to learn something. You never want to just be in one market. And if you start out in one market, you've got to be quite careful that you don't anchor to that. When you're young and you start out in one market, you've got to look at history and be careful of that. So all markets really matter for your learnings. Yeah.
Sideways markets?
Also important, of course. Of course, that's important.
Yeah, I guess we've come to the end of our podcast, and maybe I'll just get a closing remarks, your views, anything you'd like to share. Maybe just in wrapping up on your side.
I suppose it would be a sense of how we see things going forward. I mean, we think there certainly is an opportunity for decent returns to be generated from SA equity funds or from balanced funds. We think there are enough interesting and compelling investment opportunities out there for investors to get a decent return, irrespective of what political outcome, not irrespective of any political outcome, but even taking into account the stresses and strains that we're certainly seeing some decent opportunities. And I mean, I don't want to go through them again, but they're obviously the ones that we spoke about. So that gives us a sense of optimism when we look at our portfolios and we think about the returns that can be generated. That certainly gives us a good sleep at night factor, that on a sort of medium-term view, there are good returns to be had.
Awesome. Thank you. Well, there you have it. Wrapping up this episode of Meeting of Manager Minds. I hope you found this segment valuable. You took some nice, great nuggets and some valuable insights from one of the best minds in the industry. And you obviously see that we picked the best asset managers out there through our rigorous manager research process. And I mean, so what does it mean for advisors? Well, advisors, I mean, just sleep easy knowing that, you know, we've got the skilled individuals to build those portfolios, to essentially pick those stocks, do all of that work, to eventually put a portfolio together, and advisors can spend more time with clients. And I guess this brings us to the end of our podcast. Thank you for joining us. Thank you for joining Saul.
Thanks for having me.
And again, my name is Msizi Msomi, portfolio manager at Alexforbes. And I guess one parting remark is, with Alexforbes, no matter the investment destination, you're in the right place. Thank you. Thank you, Saul.
Thank you.